Silver has been cut down by more than half. From a peak of $121.64 an ounce, it now sits around $55.50, holding below 56. And every headline you have seen about it is asking the same question. Is the washout over? Is this the bottom? Have we finally found the floor? I want to tell you something uncomfortable about that question. It has no answer. Not a hard one, not a soft one, not one I have, and not one anybody else has either. Anyone who tells you they know where the bottom is in silver is either guessing or selling. But there is a different question sitting right underneath it, one almost nobody asks, and that one does have an answer. A precise, boring, arithmetic answer. And it is the question that actually decides whether this decline matters to your retirement or not. So let me start with something small, and then show you why it is not small at all. You will see the figure 51% attached to this decline all over the place, down 51% from the peak. It is a clean number. It is also wrong. And notice which direction it is wrong in. Peak was 121.64. It is around 55.50 now. That is not 51% off. That is closer to 54% off. The headline is being generous. The real number is worse than the number that is scaring people. 3 percentage points. Who cares, right? Hold that thought, because in about 5 minutes, I am going to show you that those 3 points are not 3 points at all. They are enormous. And the reason almost nobody sees that is the single most expensive blind spot in the way ordinary people think about money. First, let me lay out what actually happened, because the sequence matters. The collapse was not slow. It was not a grind. It was one of the most violent repricings of a major asset most of us will ever watch. Silver was at 121.62. Within a little over a week, it was around $64. Roughly 47% gone in about 8 days. Not 8 months, 8 days. And the trigger was not a mine flooding or a factory closing or a shortage ending. The trigger was a personnel announcement. A hawkish name was put forward to run the Federal Reserve, and the market instantly repriced the entire path of interest rates for the next several years, and everything that pays no interest got taken out and shot. Silver pays no interest. Silver got shot the hardest. Since then, it has kept bleeding, down more than 15% in the last month alone, down more than 7% in a single recent week, which is roughly twice as hard as gold fell over the same stretch. Real quick before I go further, because the next part is the whole video. If any of this is making you think about your own retirement accounts, I put together a free retirement protection guide that walks through exactly how retirees are shielding their savings in this kind of environment. It is completely free. The link is in the description, or you can just scan the QR code on your screen right now. It takes 2 seconds. Okay, back to the arithmetic. Because there is a detail in that same data that should confuse you, and I want you to sit in the confusion for a second. Silver is down more than half from the peak, and silver is also up more than 45% from where it was a year ago. Both of those are true at the same time, which tells you that the story you have been handed, silver collapsed, silver is broken, silver failed, is not actually the story of silver. It is the story of the peak. It is a story about one specific price on one specific day and how far away from that price we are now. And the distance from a peak is a fact about the peak. It is not a fact about the metal. Now, here is the thing I promised you. The reason those 3 percentage points matter, and the reason that everyone, including very smart people, gets this wrong, is that percentages are not symmetric. Down and up are not the same size, and the gap between them is not a rounding error. It is a chasm, and it widens the further down you go. Let me make it concrete, with numbers small enough to do in your head. You have $100. It falls 10%. You have 90. Now, to get back to 100, how much do you need to gain? Almost everybody instinctively says 10%, but 10% of 90 is 9. 9 plus 90 is 99. You are still short. You need 11.1% to get back to even. Small gap. Nobody cares. Try it bigger. $100 falls 20%. You have 80. To get back to 100, you do not need 20%. You need 25. The gap is growing. Falls a third. You have 67. To get back, you need 50%. The gap is now enormous. Falls half. You have 50. To get back, you need 100%. You need the thing to double. just to break even, not to profit, to break even. Now do the one that matters. Silver did not fall half. It fell about 54%. And to get back from 54% down, you do not need 100%. You need roughly 119%. It has to more than double. It has to gain more than the entire value it currently has all over again. And even then, you are only back where you started, having earned nothing. That is what those 3 little percentage points did. 51% down would need 104% to recover. 54% down needs about 119. 3 points on the way down cost you 15 points on the way back up. That is the asymmetry. That is why the headline being off by 3 feels harmless and is not harmless at all. And here is the part that should actually stop you. This arithmetic is not an opinion. It does not depend on the Fed or on the war or on whether the deficit is real or manufactured. It is not a forecast. It is division. It is true in every possible future, including the ones where I am completely wrong about everything else in this video, which makes it the only genuinely reliable thing on this entire subject. So look at what happens to the question when you put the arithmetic back in. Is the washout over? Unanswerable. Nobody knows. But what does a full round trip actually require? And can I vote for it? That is answerable. Requires roughly 119%. And whether you can wait for it depends on exactly one thing, which is not a market variable. It is your age, your withdrawal schedule, and whether anybody is going to force you to sell. That is the whole game, and I have never once seen it discussed on a chart. Now let me tell you why silver in particular does this, because it is not random and it is not bad luck. It is baked into what silver physically is. Start with supply. Most of the silver that comes out of the earth is not mined because somebody wanted silver. It comes out as a byproduct of digging for copper, lead, and zinc. It is a passenger, which means the silver price barely steers the silver supply. A copper mine does not slow down because silver got cheap, and it does not speed up because silver got expensive. It answers to copper. So the supply of silver is, to a first approximation, deaf. It cannot hear the price. Now, demand. And this is where silver splits from gold in a way that almost nobody appreciates. Practically every ounce of gold ever pulled out of the ground still exists somewhere. In a vault, in a ring, in a bar, in a basement. Gold is hoarded. Silver is not. Silver is used up. It goes into solar panels and electrical contacts and circuits and medical equipment in quantities so tiny per unit that it is not worth the cost of ever getting it back out. Gold gets hoarded. Silver gets burned. Put those two facts together. Supply that cannot respond and demand that partly incinerates the stuff. When something has to give in that system, it cannot be the volume. It has to be the price, which is why silver moves like this, violently, in both directions, over and over, forever. This is not silver malfunctioning. This is silver working exactly as designed. And you can see it in the ratio. The gold to silver ratio, which is just how many ounces of silver it takes to buy 1 ounce of gold, sits around 71. The long-run average is nearer 60. When the market gets frightened about industrial demand, when it starts pricing higher rates and a slower economy, it punishes silver's industrial half and rewards gold's monetary half, and the ratio stretches. That number is not really a price, it is a mood. And that brings me to something that matters, especially if you are sitting on $100,000 or more in a retirement account, a 401k, an IRA, anything like that. Because this is exactly the kind of environment where the arithmetic I just walked you through stops being academic. I put together a free retirement protection guide that covers the strategies retirees are using right now, including how some are moving a portion of their retirement savings into physical gold without triggering taxes or penalties inside the tax-advantaged account they already have. It walks through it step by step in plain English, and it covers the mistakes that cost people real money. It is in the description, or scan the QR code on your screen. And if you go through the guide and want to go deeper, there is a free, no-obligation, one-on-one educational session available for folks with $100,000 or more in any retirement account. Just answers, no pressure, nothing to buy. Okay, now let me show you the people who already learned this lesson and what it cost them. Because there is a country where this arithmetic is not a YouTube video. It is a personality trait. Go to Argentina. Talk to a school teacher, a mechanic, a pharmacist. Ask them where their savings are. They will not tell you about a fund. They will not name an allocation. They will tell you, without embarrassment and without ideology, that they keep it in hard money. Dollars, mostly. Metal, property, anything that is not a promise written in their own currency. They price the big things in dollars. Houses trade in dollars. And a very large share of their savings sits outside the banking system entirely because they do not fully trust the bank to still be a bank next year. Now, the easy way to hear that is as paranoia. It is not paranoia. It is memory. That country has defaulted on its debts repeatedly. Not once in some distant century, repeatedly within a single working lifetime. The pattern is almost boringly consistent. The government borrows in a calm stretch, usually in dollars. Then the currency breaks, and now the debts are in a money that has become expensive, while the tax revenue arrives in a money that has become cheap, and the arithmetic tears the country in half. Again. And ordinary savers get processed through it. Again. There was an episode where the banks were simply closed to ordinary depositors. People who had done nothing wrong, who had saved diligently, who had followed every rule, stood outside a building that contained their own money and could not have it. Nothing about their behavior caused it. The arithmetic caused it. Here is what I want you to notice about them. The Argentine middle class does not save in hard assets because they read a newsletter. They do not do it because of a theory about central banking. They do it the way you flinch when something comes at your face. It is reflex. It is what a population becomes after it has been taught the arithmetic of recovery the hard way, more than once, with its own money as the tuition. And they learned the exact lesson this video is about. They learned it in the most expensive classroom on earth. Because when your savings get cut in half, the cheerful voice tells you not to worry. It will come back. And you nod. And then you find out that coming back does not mean going up as much as it went down. Coming back means doubling. And doubling takes time. And time is the one input you cannot buy more of, and the one a retiree has the least of. That is the difference between them and us, and it is not intelligence, it is repetition. They have run this experiment on themselves several times. Most Americans have run it 0 times. And you do not get to be casual about an arithmetic you have never personally paid for. So let me come back to silver with that in hand, because the fundamentals underneath this metal are genuinely strange right now, and I want you to see the tension without me tidying it up for you. This year is on track to be the 6th consecutive year the global silver market runs a deficit. 6th in a row. The world keeps using more silver than it produces, and it has kept doing that straight through this collapse in the price. The deficit this year is around 67 million ounces. But look at how that deficit is being reached, because it is not what you would guess. Total global supply is actually rising, up about 1.5% to a decade high of roughly 1.05 billion ounces. Mine production is up about 1%, so more silver is coming out of the ground, not less. And on the other side, industrial use is falling, down about 2% to a 4-year low. The biggest single reason is solar. Silver consumption in solar panels fell about 19% to roughly 151 million ounces. Not because anyone stopped building solar panels, because engineers designed the silver out of them. The industry calls it thrifting. Silver paste can be something like 10 to 20% of the cost of a solar cell, and when your margins are being crushed, you go find the expensive ingredient and you use less of it. That is not a temporary swing. Engineering does not usually get uninvented. And yet, physical investment demand went the other way, up about 20% to a 3-year high near 227 million ounces. Somebody is buying the metal, in size, into a falling price. Sit with that combination. Supply at a decade high, industry using less, investors buying more, and the market still short for a 6th straight year. Now, is that bullish? Honestly, it is not that simple, and I am not going to pretend it is. Because retail is doing the exact opposite of the investors. The Perth Mint, one of the largest and oldest mints on Earth, saw its silver sales fall about 37% from a year earlier, and the month before that was itself the weakest monthly total in more than a decade. That is silver specifically. Their gold bullion sales held up fine. It is the silver buyer who has walked away. And think about what that means. The price fell hard, and the ordinary buyer bought less. Cheaper metal, fewer buyers. That is the opposite of how you behave with literally anything else you purchase in your life. Nobody walks out of a store because the thing they wanted went on sale. Now, let me be honest about the risk here, because I am not interested in selling you a fantasy. Silver can absolutely go lower. It has already fallen more than half, and a thing that has fallen more than half can fall more than half again. That is not pessimism. That is just the same arithmetic pointed the other way. If the Federal Reserve genuinely stays hawkish, if real returns on safe bonds keep rising, if that industrial thrifting keeps eating into demand, then silver has no floor that anybody can point to and defend. I cannot give you a price. I cannot give you a date. And the moment somebody does give you a price and a date, close the tab, because they have just told you everything you need to know about them. And here is the harder version of the honesty. Even people who turn out to be right can be destroyed by the timing. In the great inflation of the last century, gold went from a fixed official price to many multiples of it. And in the middle of that run, while the thesis was working, it suffered a drawdown of roughly 40%. Everyone who was right got shaken out anyway, because being correct and being early are indistinguishable while it is happening, and only one of them pays. So the honest answer to "is the washout over?" is "I do not know, and neither does anyone else." But you do not need that answer. That is the point of this whole video. The question you can actually answer is the one that decides your outcome. What does a full round trip require? Roughly 119%. Can you wait for it? That depends on whether you are 12 years from touching this money or 18 months. It depends on whether a required withdrawal is going to make the decision for you at the worst possible moment. It depends on whether you are a forced seller, because a forced seller does not get to be right eventually. A forced seller only gets to be right on the day they are forced. That is why the Argentines do not sit around debating the bottom. They already know the debate is a luxury. They stopped asking whether the washout was over a long time ago and started asking what they could hold through and hold in that would still be theirs on the other side. It is not sophisticated. It is scar tissue. If today raised more questions than it answered about your own savings, that free retirement protection guide is still in the description, and the QR code is on your screen one more time. It costs you nothing to be informed. And for those of you who stuck with me all the way to the end, here is something just for you. If you have $100,000 or more in any retirement account, and you mention that you watched this full video, you can claim a free, exclusive, no-obligation educational web conference. A real conversation about your specific situation, with no pressure and nothing to buy. That is only for folks at that level who made it all the way here, and you are one of them. Scan the QR code, grab the guide, and take the first step toward protecting what you spent a lifetime building. Because the percentage on the way down is a headline. The percentage on the way back is your retirement.